Hello and welcome to our session on inspections. My name is Tim Sykes, a Deputy Director in the PCAOB's Division of Registration and Inspections. I also serve as the Program Leader for the Non-Affiliated Firm Program. I am pleased to present this session to you today as part of our Small Business Forum. As we begin, I would like to express a special thanks to Kent Bonham, Brian Goodnow, and the team that has organized today's program. It is really good to be here with you today. And I would say that yesterday, actually, it was a bit sketchy as to whether I would be here or not. There were flight delays leaving Dallas, and we were waiting on pilots for the plane. And, during that period, I wasn't sure exactly how things would work out. And so I had sent a note to Ken and others about this. And there was a bit of a scramble, I believe, to develop a plan B. But fortunately, I'm here, and no one had to draw straws to see who would present this module today. And so anyway, as I boarded the plane yesterday, it was quite interesting. As I head to my seat, which was a middle seat on the left, a good ways back on the plane, I look up and there are actually two uniformed pilots sitting on the aisle and at the window. And I didn't say this, but I was thinking to myself, wait a minute. We were waiting 3 hours for pilots, and now we have extra pilots who are on the plane. And sure enough, I sat between them, and as we started our trip here, I was talking to the captain on my left. It was very interesting, having that conversation. He was asking if I was headed to D.C. for work or for business, and so we talked about that a bit. He asked who I worked for and what I was doing, and so we covered that. And then finally he paused and he said, well, I have one question for you. Is the U.S. government going to run out of money? And of course I laughed, and I had to say I have no idea, and I have no answer for that question. And then he went on to say that his wife recently retired and that he was considering retirement in the future as well. And so the conversation became a conversation about trust in the system, in the financial markets, and everything that's going on. And there's concern there that he expressed as his role and someone looking at retirement. And then it's trust. It's similar to electricity, where we all expect it to work when we flip the switch. And so I'm not here today at all to predict the direction of the financial markets, but I do believe that trust in the system is very important, and we all play a role in that process. Issuers, first of all, are responsible for preparing financial statements in accordance with generally accepted accounting principles. The auditor, they play a role in conducting audits in accordance with PCAOB standards. And then the PCAOB, especially the inspections group, of which I am a part, we perform inspections of the auditor's work. And so we all play a role, and the overall objective on this is to promote trust in the system and to protect investors. And so anyway, as we talk today, I would like to, and Ken shared the disclaimer, I will say again that my remarks today are my own and should not be attributed to the PCAOB as a whole or any board member or staff. And so let's see if we can get this to work. All right, we have a CPE code already on the screen, so you can make note of that. And then moving to our objectives. For today's session, I will focus our time on 3 general areas. First, I will provide a brief recap of our 2021 inspection results. Second, I will also share some examples for consideration of good practices that may influence audit quality. And third, I will provide an overview of our 2020 inspections, which are underway and which are rapidly coming to a close since we are in mid-October at this point. So to start, in 2021, the PCAOB inspected 141 audit firms, reviewing portions of 690 audits that generally had financial years ended during 2020. Within those inspections, for the annually inspected audit firms, we identified a collective increase in the number of audits with deficiencies in 2021 compared to our 2020 inspections. In our triennially inspected firms, we noted a significant increase in deficiencies, including an increase in deficiencies related to critical audit matters. In 2021, we continue to identify auditing deficiencies that have recurred for many years. We expect audit firm leadership to address these recurring deficiencies as a top priority, including determining the underlying root causes and reassessing the effectiveness of past actions to address the recurring nature of the deficiencies. And we have our first polling question. So before we go further, I would like to present the polling question, which is, which audit area had the most financial statement deficiencies in 2021? So we'll let the votes accumulate. The ticker is moving upward, so thank you very much for your participation. All right, so maybe we close the poll and we'll move to the next slide. And you can see overwhelmingly revenue and related accounts was selected, and that is in fact the correct answer. All right, so as we talk more about 2021 common deficiencies, in addition to revenue and related accounts, which we just mentioned, we also identified deficiencies in a number of areas, including ICFR, accounting estimates, critical audit matters, auditor tenure, and independence. During this presentation, I will provide some examples of the types of audit deficiencies we found in these areas, along with accompanying good practices in selected areas. Additionally, we will take a deeper dive in the area of critical audit matters and auditor tenure. We specifically selected these areas to discuss in greater detail as they are relevant to many of our inspections of triennial firms. Deficiencies in controls and the testing of controls remain a common occurrence in both integrated audits and when controls are tested in a financial statement audit. Despite improvements at certain firms, we continue to observe deficiencies related to testing ICFR across firms. Common deficiencies in this area include auditors did not sufficiently evaluate whether controls with a review element selected for testing operated at a level of precision that would prevent or detect material misstatements. In these instances, the auditors did not evaluate the review procedures the control owners performed, including the procedures to identify items for follow-up and the procedures for determining whether those items were appropriately resolved. Secondly, auditors did not identify and test controls relevant to the assessed risk of material misstatement. In many cases, the auditors did not identify and test controls over the accuracy and completeness of information used in the operation of a control. Deficiencies in auditing ICFR remained high, and auditors are encouraged to continue to focus on improving auditor performance in these areas. Now, as it relates to auditing revenue and related accounts, revenue continues to be a frequently selected focus area on our inspections given the complexities often associated with revenue recognition, accounting policies, and practices. The auditing of these revenue policies and practices are also quite complex at times. So despite the focus and attention by audit firms on the FASB's standard on revenue recognition, as well as the training or tools audit firms have provided their auditors, we observed frequent deficiencies related to the design and performance of audit procedures to identify and address assessed risk of material misstatement related to revenue. For example, we identified audit deficiencies that included the following three items. When determining revenue based on transfer of services provided to customers, the auditor did not evaluate whether the performance obligation for the services was satisfied before the revenue was recognized. Secondly, in addition, the auditor did not evaluate whether the allocation of the transaction price to the separate performance obligations and multiple element arrangements was based on the relative standalone selling prices. Auditor's substantive test of details also did not identify all performance obligations, determine the total transaction price, and evaluate whether allocation of the transaction price was required. And also, in another example, the auditor did not evaluate the public company's revenue recognition policy disclosures, including evaluating disclosure of the transaction price allocated to unsatisfied performance obligations. Other common deficiencies include instances where auditors in substantive testing of revenue did not test or did not perform any procedures to test, or in the alternative, did not identify and test any controls over the accuracy and completeness of data or company-produced information. As a reminder, when using information produced by the public company as audit evidence, the auditor should evaluate whether the information is sufficient and appropriate for purposes of the audit by performing procedures to test the accuracy and completeness of the information, or test the controls over the accuracy and completeness of that information, and then also evaluate whether the information is sufficiently precise in detail for purposes of the audit. In addition to auditing revenue, another area of common deficiency in our inspections is auditing accounting estimates. Many financial statement accounts contain accounting estimates, which could in turn involve subjective assumptions and measurement uncertainty and may present heightened risk of material misstatement. While we have observed improvements in auditing estimates, deficiencies continue to occur, particularly in auditing the allowance for loan loss, estimates related to accounting for business combinations, investment securities valuations, and long-lived asset impairments. Common deficiencies in auditing estimates included instances where auditors reviewed management's memorandum describing the assumptions used in determining the all, but did not evaluate the qualitative factors or evidence supporting certain assumption changes from the prior year, or perhaps lack of changes from the prior year when evaluating the reasonableness of the assumptions. In addition, auditors did not evaluate the reasonableness of significant assumptions used in a financial statement forecast to determine the fair value of certain acquired assets, because the auditors did not evaluate whether there were reasonable basis for those assumptions or whether those assumptions were consistent with relevant industry and other external factors. Also, they did not consider whether these were consistent with the company's objectives, strategies, and related business risk and existing market information. Further, auditors did not evaluate the appropriateness of the valuation models and the reasonableness of significant assumptions used by the public company in determining the fair value of investment securities. In another example, auditors did not evaluate the reasonableness of significant assumptions used when evaluating the recoverability of certain long-lived assets, because the auditors did not evaluate whether these significant assumptions were consistent with industry, regulatory, and other external factors. They also did not evaluate whether they were consistent with the company's objectives, strategies, related business risk, and existing market information. So now it's time for another CPE code. So please take a note of that code for your records. All right, moving on to another common area of deficiencies is related to critical audit matters. We reviewed approximately 400 audits in which auditors were required to determine whether there were CAMs, and if so, communicate those CAMs in the auditor's report. We identified deficiencies in approximately 1/3 of those audits in our reviews. Most deficiencies are instances where auditor procedures to determine CAMs did not include every matter that should have been analyzed as a potential CAM. These instances of noncompliance do not necessarily mean that other CAMs should have been communicated in the auditor's report. In other words, there were matters that were communicated or required to be communicated to the audit committee and that related to accounts or disclosures that were material to the financial statements, for which the auditor did not include them in the determination and documentation as to whether they were CAMs. Now, one way to look at this, perhaps in a more summarized fashion, is what we're talking about here is the auditor had an incomplete population. There were items that were missing from the CAM evaluation, and this, in fact, is our most common CAM finding. And on the other hand, we have also seen instances where matters were included in the documented determination that they were not CAMs, but the documented determination was not adequate. That could be because the basis for the matter not being a CAM was unsupportable, as the documentation may be inconsistent with the nature and extent of audit work performed and the application of auditor judgment when auditing that matter. Alternatively, there could be an instance where there is no evidence in the audit documentation for the basis of why something was not a CAM. Maybe it was documented that it was not a CAM, but not documented as to why. Another way to look at this category of deficiencies is perhaps that the auditor had identified the right population of items to be evaluated, but the rationale was either lacking or missing as it related to those items. We have also identified deficiencies in the CAM communications in the auditor's report. These deficiencies could be due to the description of the CAM in the auditor's report of not being accurate, perhaps because it was inconsistent with the audit evidence in the audit file, or it could be a deficiency because certain required elements in the CAM communications were missing, such as not including a reference to the relevant financial statement accounts or disclosures that relate to the CAM. As I mentioned earlier, we noted a significant increase in deficiencies among triennially inspected firms, largely related to CAMs. So we will actually spend a few more minutes and discuss this further. As a reminder, a CAM is a matter arising from the audit of the financial statements that was communicated or required to be communicated to the audit committee, that relates to accounts or disclosures that are material to the financial statements, and C, involved especially challenging, subjective, or complex auditor judgment. CAMs are determined from matters arising from the audit of the financial statements, and thus are rooted in the financial statements themselves. CAMs are also drawn from matters required to be communicated to the audit committee, even if they're not actually communicated, and matters that were actually communicated, even if they were not required communications. When we talk about relates to accounts or disclosures, CAMs are required to relate to accounts or disclosures that are material to the financial statements. Materiality is not solely based on quantitative factors. It also reflects qualitative factors. This element of the CAM definition is grounded in the framework, in the financial statement presentation and disclosures of the applicable financial reporting framework. And it is also important to keep in mind that the matter itself may not be material, but if it relates to a material account or disclosure, it could still be a CAM. A CAM may also relate to components of an account or disclosure that is material to the financial statements, rather than the entire account or disclosure. For example, if goodwill is material to the financial statements, a component of goodwill could potentially be the subject of a CAM, or the auditor's evaluation of the company's goodwill impairment assessment for one of several reporting units involving especially challenging, subjective, or complex judgment, and the auditor may determine that a CAM exists even if there is no impairment. The CAM would relate to goodwill recorded on the balance sheet and the disclosure in the notes to the financial statements about the company's impairment policy and goodwill. Again, the matter itself, in this case, an impairment of 0, may not be material, but it does relate to a material goodwill balance and disclosures, and so it could be a CAM. A CAM could also relate to many accounts or disclosures and have a pervasive effect on the financial statements. For example, the auditor's evaluation of a company's ability to continue as a going concern could represent a CAM depending on the circumstances of the individual audit. Under the standard, the determination of CAMs is principles-based, and the standard does not specify any items that would always be considered a CAM. The auditor is required to determine, in the context of the specific audit, that the matter involved especially challenging, subjective, or complex auditor judgment for the matter to be a CAM. Also, CAMs are required for the audit of the current period's financial statements only. So the determination and communication of CAMs is done every year in connection with the current period audit. While the previous year's CAMs may be a good starting point when thinking about possible CAMs, the CAM determination is based on the facts and circumstances of the current year's audit and not on updating previous CAMs. The requirement of the standard is to document how the auditor determined whether matters communicated or required to be communicated to the audit committee and that relate to accounts or disclosures that are material to the financial statements or CAMs. As we discussed, there are 3 criteria for which a matter to be considered a CAM. Essentially, the documentation requirement is that for everything that meets the first 2 criteria, an auditor is required to document whether or not the 3rd criterion is applicable, and to also document the basis for that determination. Consistent with the provisions of AS 1215, audit documentation, the audit documentation is required to be in sufficient detail to enable an experienced auditor, having no previous connection with the engagement, to understand the determinations that were made. The documentation can be done in a variety of ways, and also the length and nature of the documentation will depend on the underlying matter and could be relatively brief. On one hand, for matters that are determined to be a CAM, an appropriate description in the auditor's report will generally suffice as documentation. On the other hand, for matters ultimately determined not to be CAMs, the auditor is required to document in the work papers the basis for the determination. In other words, while the matter did not involve especially challenging, subjective, or complex auditor judgment, there is no requirement to document the consideration of each individual factor listed in AS 3101. Specifically, paragraph 12 of AS 3101 lists a number of factors that the auditor should take into account alone or in combination when determining whether a matter involved especially challenging, subjective, or complex auditor judgment. But that does not mean that an auditor necessarily needs to document the consideration of each and every individual factor. So, as I mentioned before, the documentation needs to enable an experienced auditor not related to the engagement to understand the determination that was made. All right, as it relates to drafting CAMs, AS 3101, paragraph 14 states that for each critical audit matter communicated in the auditor's report, the auditor must identify the CAM, describe the principal considerations that led the auditor to determine that the matter is a CAM, and describe how the matter, excuse me, the auditor must identify the CAM, describe the principal considerations that led the auditor to determine that the matter is a CAM, and then describe how the CAM was addressed in the audit. We also need to refer to relevant financial statement accounts or disclosures that relate to the CAM. Note for the 3rd item, describing how the CAM was addressed in the audit, the auditor must choose to do that by describing the auditor's response or approach that was most relevant to the matter. a brief overview of the audit procedures performed, an indication of the outcome, and the key observations with respect to the matter, or some combination of these elements. Now we have another polling question. So let's see. Cams are grounded. As you can see, the question, we'll give everyone a minute to respond. There are some votes coming in. All right, so we will close the poll. And as you can see, item B received the most votes, and that is the correct answer. Okay, moving to another common area of deficiencies related to auditor tenure and auditor tenure reporting requirements. We identified deficiencies related to auditor tenure in our 21 inspections. In certain instances, the auditor did not report the year the auditor signed an engagement letter or began performing procedures, but rather the year the auditor signed his first audit report. In another example, the auditor did not appropriately reflect the entire relationship between the company and the auditor, which includes relationships involving predecessor firms and predecessors under the company under audit. Since this is another area that is relevant to many of our inspections of smaller firms, we will discuss this topic in a bit more detail. Public disclosure of auditor tenure is important and in the public interest. It is appropriate to require disclosure in the auditor's report because it is the primary means by which auditors communicate with investors. This ensures the disclosure is in a readily accessible and consistent location, the auditor's report for all companies. The disclosure of auditor tenure is intended to add to the mix of information that investors can use. AS 3101, paragraph 10, item B, requires a statement in the auditor's report containing the year the auditor began serving consecutively as the company's auditor. The disclosure of tenure should reflect the entire relationship between the company and the auditor, including the tenure of predecessor accounting firms and engagements by predecessors of the company under audit. A company's benefit plan that files annual reports on Form 10-K would be considered a separate issuer. Therefore, it would have a separate tenure determination. And we have another polling question. This is a true or false question, so I'll give you a moment to read this and for the votes to be cast. The counter is increasing significantly, so thank you for your participation. There's still time to cast your ballot, but we are now closing the poll. And let's see. The correct answer is false. So the overwhelming majority selected the correct answer. And I guess the point of this is to say that if a company went public and maintained the same auditor tenure would include the years the auditor served as the company's auditor both before and after the company became subject to SEC reporting requirements. In other words, the auditor's relationship with the company is not affected by the company's status as a public company. Okay, we'll move to the next slide. We'll spend a few minutes talking about the determination of auditor tenure. The sources for the determination of auditor tenure are based on the auditor's own records. The company's records are publicly available information. which would be current or periodic reports on Edgar, or absent other information about when the auditor signed an initial engagement letter and began performing audit services. And in this category, it can be based on the year the auditor first issued an audit report on the company's financial statements, or if earlier, the auditor's estimate of when work would have commenced to enable the issuance of such a report. Now, we have provided sources of auditor tenure determination. Let's look at a few examples to further clarify this concept. Okay, for scenario one, bear with me here as I read these to you. If an auditor signs an engagement letter in January of 2020 to audit the company's financial statement for the year ended December 31, 2020, and the auditor's report is dated in February of 2023, the auditor would state 2022 as the year the auditor began serving consecutively as the company's auditor. Scenario two, if the auditor signs the engagement letter in December 21 to audit a company's financial statements for the years ended December 31, 2020, 21, and 22, the auditor would state 2021 as the year the auditor began serving consecutively as the company's auditor. In scenario three, if the auditor signs an engagement letter in January 2023 to audit a company's financial statements for the year ended December 31, 2020, 21, and 22, the auditor would state 2023 as the year the auditor began serving consecutively as the company's auditor. Now, what is the common denominator here? The common denominator is the year that the engagement letter was signed. So that, is the disclosure that's required. If there is uncertainty as to the specific year the auditor began serving consecutively as the company's auditor, such as due to firm or company mergers, acquisitions, or changes in ownership structure, the note to AS 3101-10B says the auditor should state that the auditor is uncertain as to the year the auditor became the company's auditor and provide the earliest year in which the auditor has knowledge. The following is an example of such a statement that could be included in the auditor's report. We're uncertain as to the year we began serving consecutively as the auditor of the company's financial statements. However, we are aware that we have been the company's auditor consecutively since at least, and you state the year. All right, moving on to the next slide. Additional reporting considerations. Auditors have discretion to provide additional information in the auditor's report about tenure. And that's as if that information would provide context or otherwise assist the reader's understanding of the relationship between the auditor and the company. For example, when tenure is calculated, taking into account the tenure of the predecessor accounting firms and or the engagement by predecessors of the company under audit, the auditor may provide information about these historical relationships. Auditors may also use other information to express uncertainty regarding when the tenure began, as long as the statement effectively communicates the first year the firm knows that it served as the company's auditor and that it is uncertain as to the specific year when the tenure began. An example of this could be a disclosure that says, we have not been able to determine the specific year that we began serving as the company's auditor. However, we are aware that we have served as the company's auditor since at least, and you state the year. Another option is to disclose we have served as the company's auditor since at least a certain year. However, an earlier year cannot be reliably determined. The explanatory language should not state or imply that the auditor did not make a tenure determination. So what was troublesome here is a disclosure that says we have not determined the specific year in which we first served as the company's auditor. As it relates to tenure reporting by predecessor auditors, when the auditor's report is reissued by a predecessor auditor, a predecessor auditor may expand the tenure statement to indicate when the tenure ended. And finally, the disclosure of auditor tenure is not required in the auditor's separate report on ICFR. For more information on this, please see the staff guidance, changes to the auditor's report, effective for audits of fiscal years ending on or after December 15, 2017, which was also updated in August of 2018. All right. Now, having covered some of our 21 common deficiencies identified on engagements selected for inspections, I would like to turn our focus to observation related to the firm's quality control system. As part of our commitment to promoting consistent high-quality audits, we view an effective QC system within an audit firm as a means to prevent, identify, and remediate audit quality deficiencies. In 2021, we enhanced our approach to inspecting firms' QC systems as part of our goal to move towards a more preventative regulatory approach. Our QC procedures are scalable and involve evaluating the audit firm's QC system based on the size, nature, structure, and complexity of the audit firm. We perform our QC procedures to gain or update our understanding of the design of an audit firm's QC system. Our assessment of an audit firm's QC system is derived from the results of our QC procedures as well as from analysis of the deficiencies identified in individual audits. We also consider other available information, for example, results of that audit firm's own internal inspections, security regulator investigations and enforcement actions that may provide evidence as to the effectiveness of a firm's QC system. In the last 2 years, we refined our inspection procedures for annually inspected firms and continue to increase our focus on the QC area that are most likely affected by COVID-19 and related economic uncertainty. In 2021, we continue to evaluate how audit firms' ongoing modification to their QC systems were affecting audit quality. We also tailored our approach to inspecting QC systems at smaller audit firms and piloted our approach to triannually inspected audit firms in non-U.S. affiliates. Now, to speak a bit about our observations related to quality control. First, among the deficiencies related to quality control is in the area of independence. While I am sure you have heard this many times from many different sources, it bears repeating that auditors are required to be independent of their audit clients, both in fact and appearance. Independence is a critical element to be addressed by a firm's QC system and remains an area for improvement. In 2021, we continue to identify violations of financial relationship requirements of Rule 201 of the Commission's regulations, and for some audit firms, we identified instances where audit committee approval was not obtained for certain audit-related services, non-audit services, or tax services prior to the auditor being engaged to perform such services. Additionally, we have observed that certain annually inspected firms have instituted financial relationship reporting requirements, and some of these firms continue to report a high rate of noncompliance by audit firm personnel reporting their financial relationships into the firm's monitoring systems. This provides cause for concern, obviously. Specifically for smaller firms, we also observed deficiencies related to PCAOB Rule 3524, Audit Committee pre-approval of certain tax services, and PCAOB Rule 3526, communication with audit committees concerning independence. All right, it's time for another CPE code. And then we'll talk a bit about good practices. As a reminder, a good practice could be a procedure, technique, or methodology that is appropriately comprehensive and suitably designed in relation to an audit firm's size, and the nature and complexity of the audit firm's practice, and that may contribute to the quality of audit services. Some of the good practices we observed during our 21 inspections include some of this related to critical audit matters. This was the first year that CAM requirements, for many audits conducted in 2021, 21 was the first year that CAM requirements were applicable. For other audits of large accelerated filers, this was actually the second year of implementation. For those audits, the ones in their second year of implementation, we identified fewer deficiencies. This could be attributable to good practices, including the following. Some auditors developed tools to track every matter communicated or required to be communicated to the audit committee, which helped ensure that all potential CAMs were considered in the determination process. As discussed above, beginning with the audit committee communications is the appropriate starting point. Another good practice is the involvement of others in reviewing draft CAM communications to be included in the audit report. And when we say others, we mean designated subject matter experts in the firm or consultation resources of a formal or informal nature devoted to this topic. We have also seen firms develop internal resources such as guidance documents or dashboards that offer example language as a starting point for tailoring CAMs. When drafting CAMs for an auditor's report, we encourage you to consider these good practices and perhaps consult other spotlight documents on our website to prevent audit deficiencies from occurring and to produce audits of high quality. In addition to these good practices, some other examples we observed, which may be particularly beneficial for smaller firms, include good practices related to independence. We've also observed items in this area whereby certain firms have increased the frequency for personnel to provide independence compliance representations to a quarterly or a semi-annual basis. To enhance the process, certain audit firms have tailored the representations based on personnel's financial interest and our services provided. A couple of other good practices would be an audit firm also employed an improved process that walks professionals through their financial holdings, including their close family members, spouses, and dependents, to ensure that all factors are evaluated. And the last item I'll mention here is audit firms have put in place policies and procedures providing sanctions for personal independence violations. This process includes audit firms assessing the severity, frequency, and nature of personal independence violations and determining disciplinary actions commensurate with the violations, and this could also include monetary sanctions. Now, having covered some of our 2021 inspections, common deficiencies, examples of good practices, more information on CAM and auditor tenure, I want to turn to the remaining minutes of our session this morning to our 22 inspections, which are currently underway. Many of our inspection plans for this year were presented in our staff overview for 2022 inspections that we released in June. Given that our time today is limited, that spotlight document offers greater detail on what we are doing this year. I will focus my remarks on just a few highlights from that publication, but I would encourage you to consult it for additional information. We developed our 22 inspection procedures to focus on anticipated financial reporting and audit risks that are primarily driven by the recent economic environment. The environmental changes the risk landscape. The environment changes the risk landscape for all issuers and may increase existing financial reporting and audit risk or create new risk, including fraud risk for public companies. We continue to place emphasis on audit procedures addressing the risk of material misstatement, including the risk of fraud at companies due to the accounting complexities, significant adjustments, and changes involved in the audits of financial statements and internal control, including, among others, those related to initial public offerings, mergers and acquisitions, and transactions with special purpose acquisition companies. We've also focused on the widespread disruption in supply chains, for example, electronic components and equipment, automobile, retail, and materials. Another item that we focused on is continued negative effects of the COVID-19 pandemic, especially in industries that were particularly affected. Increased volatility in financial and commodity markets due to fluctuations in interest rates and inflationary trends was another area that we considered. And then finally, the item I would mention here is that we focused on audit firm-wide risks, such as the heightened degree of staff turnover and risk arising from auditing in a remote environment, including the risk that auditors will not identify misstatements that could be material. And so now we have another polling question. What auditing and accounting risks do you think our inspectors are focusing on in 2022? I'll give you a moment to respond to this one. All right, we're about at a good point here, so we'll close the poll. And the correct answer is all of the above. So thank you very much for your participation. All right, let's move to the next slide. So as it relates to this, the auditor's assessment of the risk of material misstatement and identification and testing of the design and operation of controls are critical to designing the appropriate audit response. And I'm talking about the nature, timing, and extent of testing. And this is important in an audit of ICFR. As it relates to our inspections, we continue to perform procedures related to the auditor's risk assessment for each financial statement focus area selected for review. We also maintain a focus on how the auditor evaluated internal controls, addressing the completeness and accuracy of financial statement disclosures for the areas selected. And then finally, we review whether there was proper identification, assessment, and testing of internal controls, especially those controls that changed because of the current environment. And to round out our conversation on 2022, we also are inspecting areas such as a firm's compliance with auditor independence requirements, how a firm determines and communicates critical audit matters, which we discussed in detail in our presentation today, how firms are addressing areas with continued deficiencies, how firms are complying with existing QC standards, and then finally, how firms are auditing digital assets and responding to cyber threats and the use of data and technology in the audit. As I conclude my presentation today about our inspections, I want to leave you with some reminders that given the challenges in the current economic environment that I would encourage you to keep in mind. First, auditors need to exercise professional skepticism in evaluating the reasonableness of management's representations, estimates, and forecasts due to the uncertainty and volatility of the economic environment. Second, auditors should consider whether the remote or hybrid working environment at public companies creates any new or increased risk of material misstatement, including any fraud risk. And finally, auditors should remain alert to changes in the public companies or the auditor's circumstances that may give rise to situations that could impair auditor independence. And I have one more CPE code for you. You may want to jot this down. And then I want to thank you for attending this session of our forum today. And I would leave you with a reminder that much of what I have covered can be found in the Spotlight document and in other documents on our website. You can find most of these listed on the website in the Resources tab and there will be listed all of the spotlight documents. And then also, as it relates to auditing CAMs, I would encourage you to actually look at the standard itself, AS 3101, and there are a number of documents that are highlighted in the preamble or the opening part of that standard. And so with that, let me pause to see if we have some questions, which it does look like a few have came in. And so let me see, give me a moment here to just run through these. Okay, let me just run through. Okay. Was there any determination about the background auditors have with respect to audit deficiencies in revenue recognition and understanding of ASC Topic 606, revenue from contracts with customers? As it relates to the procedures we perform, we do evaluate the firm's compliance as it relates to auditing in this area. And then as it relates to any deficiencies that may have been identified, the firm would need to perform their own procedures to identify root causes as it relates to the deficiencies that have been identified. And we encourage firms, as I mentioned earlier, to really look at this to try to determine the root cause. And if perhaps it is a background issue or a training or technical competence issue, the firm should take appropriate steps to address that to prevent these type deficiencies from recurring in the future. I got a few questions about CAMs. One is, CAMs are only required for public companies, right? That is correct. And then are they required for broker-dealer audits? And I believe the answer to that is no, they're not required. But we will have a presentation from our broker-dealer group later today, and perhaps I'll pass this on to them for additional context, but I believe that would not be the case. And then what about accounting firm mergers? How do those affect the tenure determination? And as it relates to that, as I said, the mergers, do come into play, but the relationship tracks the tenure of the predecessor firm as well. So the tenure doesn't start over upon the merger of a firm. And there is additional guidance that you can find on our website in this regard. So there are a few other questions, but I believe we're about out of time. So I will hand it back to Ken Bottom at this point. And so I really do appreciate your attendance today. And I hope that you have found this session informative, and I hope that you find the remaining sessions today of benefit to you as you conduct audits of the public companies for which you're auditing. So thank you very much for your time today.